Good afternoon, everyone. Welcome to the webinar. My name is Ted Everett, and I'm a member of CFA Boston's Programs and Education Advisory Council. Today, we are joined by Erik Weisman, Chief Economist of MFS Investment Management, for an in-depth look at inflation. We are probably at peak press coverage of inflation right now, at least I hope so. So the challenge is to bring more than just surface level insight to the topic. Erik has been thinking about this topic for quite some time and has dug into the longer term factors driving inflation beyond just next month's core CPI change. These are the factors that he'll be discussing today. Erik is Chief Economist and Portfolio Manager at MFS. As a member of the fixed income team, he manages the firm's US and global inflation adjusted, global total return, and global government portfolios. He chairs both the fixed income strategy group and the global rates and currency group. He's also a member of the risk opportunities group and the macro micro group. Prior to joining MFS in 2002, he served for 2 years as assistant to the executive director for the IMF. He also served 2 years as an international economist in the Office of Central and Eastern Europe in the US Treasury Department. Erik earned a bachelor's degree from the University of Michigan and master's and PhD degrees from Duke University. Before I turn things over to him, let me preempt the question. Yes, slides will be available. What self-respecting economist would be complete without some supply and demand charts? And we will be recording the event. We'd also like to answer questions at the end of the presentation, but feel free to drop them in the Q&A box as they occur to you. And with that, Erik, over to you.
Great. Well, thank you, Ted. And thank you for showing up. Hopefully I can leave you with a thing or two to think about. So the case for inflation. What I would like to do is show you some history so that we can put our current world into the proper context, talk a little bit about COVID and how that has impacted our thoughts on inflation, then take a look at the last business cycle and ask why we didn't see inflation despite the fact that we printed an awful lot of money, and then ask the question how this time might be different relative to the past, and especially relative to the aftermath of the global financial crisis. So if we look at history, if you have a picture in your head of what inflation looks like, it probably starts somewhere in the 1960s, and you know it was low, and then you know it started to creep up in the late 60s for a bunch of reasons. There were some bad crop years. Then we had OPEC oil embargoes, and we saw inflation vault higher a couple of times. And then we have Paul Volcker come in and generate a recession to tamp down on inflation, and we have seen inflation disinflate, if you will, really ever since then. So it looks like an upside down V to some extent. But if you were to extend that history back, let's say another 50 years, you can see the volatility in inflation, and high inflations around wars, low inflation right after World War I and during the Great Depression. So it's not quite as uniform a story perhaps as some people may have in their head if you go back far enough. So what has been driving the last 40 years? And many of these dynamics are ones we should be familiar with. Demographics, as populations get older, they tend to be a little bit less dynamic, and there are reasons to believe that that is causing disinflation. I say that may be peaking. That isn't to say that demographics are peaking overall. It's to say those people who save the most money, that group may be peaking. And that will be an interesting thing to watch as we go forward, thinking about those who save and those who want to invest and looking at that relationship. Automation and digitalization has been disinflationary, this winner take all, where you have these mega cap companies that are monopolistic or oligopolistic. History would tell you that eventually they gain market share and then they really take it to you and they raise price. That's not what's been happening in the last couple of business cycles. These mega cap companies compete on price. So that's been disinflationary and ahistorical. The rise of intangibles is this notion that you can take a company like Uber and Airbnb. You don't need a lot of capital. You don't need a lot of labor. You don't demand a lot of inputs, and you can create a company with a lot of wealth. So lots less brick and mortar and a lot more of software. And again, these sort of intangible inputs. High and rising debt levels are calcifying unless you decide to make a political decision that you will inflate them away. And we'll talk a little bit about that. Are we really trying to monetize the debt? People thought so in the aftermath of the global financial crisis, but we didn't really do it. If you're not going to monetize the debt for real, then debt tends to calcify both growth and inflation. Globalization, finding the cheapest input to your production all around the world, has been disinflationary, especially as we added China into the mix. And after the fall of the Soviet Union and the Eastern Bloc. And all of this stuff has been somewhat self-reinforcing to create a very low volatility world, both in growth and inflation. So if there's very little volatility in inflation, then what inflation has been is what it will be. And therefore, it can be somewhat self-perpetuating. So we'll talk about COVID just for a second. And this isn't what I think is going to drive inflation as we think about the medium term, but it certainly has people exercised at the moment. So thinking back to your favorite Macro 101 class, and I'm sure you still have your textbook, I know I have mine, and we'll look at some supply and demand curves. So early on in the pandemic, we shut the economy, the global economy, down. And in doing so, we saw a shift in demand and supply, negative supply shock, negative demand shock, both curves move in. Unambiguously, quantity falls, but it depends on how much demand falls relative to supply as to whether price will rise or fall. We know, though, that demand fell more than supply because we can see it in the results. Inflation numbers fell around the world, and that validates the idea that it was more of a demand shock, more of a negative demand shock than a negative supply shock. Fast forward to where we are now, and everything's happening in reverse to the right side of the slide. And you can see that demand is shifting out more than supply. We have these rolling bottlenecks going on around the world. It is a lot easier to shut the global economy off than it is to reopen it. And when you reopen it, you need to coordinate it, and we're not doing that. So we have demand that's outstripping supply, quantity rises, and in this case, prices rising as well. And the question is this persistent or is it temporary? And we'll talk a little bit about that. And thinking about these bottlenecks, again, this is what has everybody exercised. And you can look at things like the US-ism, asking manufacturers how they feel about certain metrics. And we can look at this around the world with global PMIs, purchaser manager indices as well. And we see all sorts of evidence to support the idea that there are bottlenecks, that delivery times are increasing, that manufacturers are having a difficult time finding inputs to their production, not just in labor, but in other inputs. And we know that there's a problem right now with computer chips. We had an episode in the Suez Canal. And you can see on the chart dating back sort of 40 years, the price index for manufacturing is pretty much at an all-time high. Again, is this going to be persistent? By their very nature, bottlenecks tend to be temporary, but can it result in something that's more persistent? Now, when we talk about inflation, I think a necessary, though not sufficient, condition to have persistent inflation, and I want to keep saying that word, persistent, durable inflation, is that you have a positive output gap. So what do I mean by that? Positive output gap basically means that you are using all of your potential inputs, labor, capital, land, at almost more than what is efficiently optimal. So when you have a lot of unemployment, when you are not utilizing capital and your capacity utilization numbers on manufacturing are quite low, that light blue line is going to be well below zero. After the global financial crisis, you can see we created a negative output gap of something like minus 5%. That means we were producing at 5% less than what was optimal. And you can see from the line here that it took almost 8 years in that business cycle to get rid of that negative output gap. The dark blue line and the light gray line are looking at not the inflation rates, headline and core, but the change in the inflation rates. And what you can see somewhat systematically looking at 60 years of history is that when the output gap, that light blue line, goes above zero, you're producing above potential, unemployment rates fall well below what you would consider to be sustainable levels. That's how you can change the level of inflation, and it can run a little bit hotter. So what happened as a result of the pandemic? We saw the output gap cascade lower into negative territory, minus 4, minus 5%. Unlike the global financial crisis, where it took 7, 8, 9 years for that to close, it looks like we're going to close that output gap in about 12 to 18 months. So in some respects, you can consider the beginning of 2022 as almost being the equivalent of 2018 in the last business cycle. Is that enough to generate persistently higher inflation? Well, it certainly should be easier than during the last business cycle. So I keep referring to the global financial crisis and its aftermath, and I think we do that because almost everyone thought printing all of this money through QE was going to give us inflation, and I was one of them. And it took quite a long while before I changed my mind, and it took a very long while for others to change their mind as well. And the reason that we thought that would be inflationary is because we have in the back of our head this famous quote from Milton Friedman in 1970, where inflation is always and everywhere a monetary phenomenon. And we think of that through the lens of, again, going back to your Macro 101 class, the quantity theory of money. The change in money growth multiplied by the change in the velocity of money is going to equal the change in nominal GDP, MV equals PQ. The velocity of money, as a refresher, is just the number of times that a unit of currency sloshes around the economy in any given time period. So let's say a year. So if you print some money and then it winds up circulating through the economy more frequently, that can create more nominal GDP. In the short term, we think of Q, real output, as being fixed. And when Milton Friedman made this statement, he was thinking of velocity as being fixed, in which case this equation simplifies to the change in money equals the change in inflation. And that's what we all had in our head when we saw the Fed printing all this money in quantitative easing. We didn't ask the question, though, what money are we actually talking about? M0, M1, M2, something broader than that. And is it the case that velocity is constant? And what about this thing called the money multiplier? The money multiplier gets at the idea that the Fed can print money and put it in the trough, but it doesn't mean that it gets out into the system. So all of these variables are important. If you look at the chart, what you will see is right after the global financial crisis, as the Fed is printing a lot of money, you see those two lines dipping down, M2, which is a relatively narrow measure of money, and then M4, which is a very broad measure of money, and they both cascade lower. So despite the fact that the Fed is printing an awful lot of money, the change in the money supply that's getting into the system is actually falling. Why is that? Well, the reason is during and in the aftermath of the global financial crisis, we had a lot of deleveraging. So the Fed is printing an awful lot of money, but the economy is delevering, and it's especially banks. So if you look at the chart, you see the maroon line. We hit the global financial crisis, and the Fed prints money of almost 10% of GDP. The maroon line is the Fed's balance sheet as a percent of GDP. And then over the course of the next several years, another 10% of GDP. So the Fed is printing money, essentially 20% of GDP. What's happening at the same time? Well, as a measure of leverage, we're looking at commercial bank loans, and that declined as a percent of GDP by 5 percentage points. So the Fed prints money to 20% of GDP, bank credit goes down by 5%. The multiplier on that bank credit is huge. And all the Fed is doing is offsetting the deleveraging, first by the banks, then by the households, and starting in 2010, and we'll talk about this in a minute, then by fiscal austerity and the government. So that's one reason. You can print as much money as you want, but if there's deleveraging in the economy, it's going to be very difficult for it to get into the system. And just to highlight this idea of MV equals PQ, what M are we talking about and what's velocity again? Milton Friedman made his famous quote when velocity, that dark blue line here, was basically constant for a generation. But it historically hasn't been constant. It's moved all over the place over the course of the last 120 years. And the money multiplier as well, the M2 money multiplier here, has also been fairly volatile. What happened during and after the global financial crisis? Velocity fell because people didn't want to spend. People were hoarding money. Corporations were hoarding money. If you print a lot of money and you stick it in your pocket, nothing happens. And the money multiplier also was declining. So you print the money and it never really makes it out into the system, into broader measures of money. Let's look at a few historical examples. How do you generate inflation? Well, it's not money growth alone, and I've just hinted at the idea that one thing that can prevent inflation, even if you have money growth, is deleveraging. But let's take a look at some episodes and see if we can learn something from history. If we look at World War I and World War II, you can see from this chart, which is a little bit confusing, but I'll explain it, that we have a lot of money printing. That's the blue bars. So the blue bars are well above zero during World War I and World War II. The change in money is positive. Velocity, the green bars, are also positive. So you are printing money and it's making its way through the system more regularly. The growth rate of velocity is rising. The other thing that we have going on during these two episodes is the output gap is positive. There's no unemployment during World War I and World War II. All capital is being utilized, and there's no deleveraging really in the part of the economy that matters. The household actually did delever a little bit. The government's levering up, and corporations are kind of being forced to lever up. So you have no deleveraging, you have a positive output gap, you're printing an awful lot of money, and that money is making it through the system. And lo and behold, you look at the tan line and you have inflation. Let's look at the opposite case in the Great Depression. What happens in the Great Depression? Money growth is negative. The blue bars are below zero. The velocity plummets lower. People don't want to spend it. They want to keep it in their pocket if they have it. And you wind up having a negative output gap. Unemployment's 25%. Capacity utilization plummets, and you get deflation. Cumulative deflation during the Depression was about 25%. Cumulative growth declines was about 25%. Nominal GDP was down almost 50%. Now let's look at the 1970s. What happened in the 1970s? We know that we got inflation then. What happened? A lot of money growth. The blue bars are above zero. Velocity is kind of neither here nor there. We have a positive output gap. We have very little deleveraging, and you get inflation. What about the productivity miracle of the 1990s? So look at that, and you see the 1990s, the blue bars are above zero, the velocity is above zero, the output gap is above zero. How come we didn't generate inflation? Because of the magic of higher productivity. When you have higher productivity, that's another hurdle to getting inflation. The more productive an economy is, the less likely you will actually generate inflation that's passed on to the consumer sector. And then finally, what I've got here in this green box, why didn't we get inflation? So we printed a lot of money. Look at the blue bars, way above zero. That's the Fed doing quantitative easing. But we had a negative output gap. We had deleveraging. We had velocity that was falling. We had money multipliers that were falling. And all of that prevented inflation. So what do you need to get inflation? You seem to need an awful lot of things. you need some money printing. It needs to be persistent. You need the velocity of money to stop falling. You need an economy that's not delevering, and you need an output gap that is positive. And you probably need a world where productivity is not rising markedly. That's an awful lot of stuff to generate inflation. So that's sort of the backward-looking element of all of this. So before we go on, we do have a poll question where we're going to ask you your thoughts on what you think inflation will look like going forward. So if you could take a moment or two and express your view here. What do you expect inflation to average during the current business cycle, however long that might be? So let's give that just another few seconds. All right. And here we go. The majority of people think that we're going to be between 2 and 4%. So for those who think we'll be less than 1% is 0. Those who think it'll be around 1% is just one voter out of what looks like around 40 or 50. 2% is the plurality at about a third. Another third thinks 3%-ish. And then we have about a fifth that think 4%, and above 4% is about 8% of folks. So looks like most people think it's going to be a little bit more the same. What I would like to suggest to you is that it will be a little easier to generate inflation in this next business cycle, but the idea of 2 to 3%, I think we have a very smart crowd here, because that's what I think too, and we can't all be wrong. So why might this time be different? One of the things that I want to leave you with is the notion that inflation historically has really been kind of a political decision, especially if you think back to the Weimar Republic and you think of the hyperinflation in Germany and Austria back in the 1920s. If you think of the hyperinflations in Yugoslavia and Zimbabwe, these are political decisions or political mistakes. So when I talk about fiscal policy and monetary policy, that's the government doing something. And I think they will have to decide they want more inflation, really meaningful inflation, or make a mistake in order for us to see inflation that really gets out of the box, 4, 5, 6% for any length of time. But let's talk about fiscal first. And everybody is, I think, focused on this notion of modern monetary theory. And it's always fun when I say that, so that I get to then say it's not modern, it's not monetary, and it's not a theory. The idea is really sort of Keynesian, although the specific ideas of modern monetary theory date back about 30 years. It's not really monetary, it's fiscal, and it's not a theory. But we'll take it for what it is. And if we look back again at the aftermath of the global financial crisis, what we see is that countries were implementing fiscal austerity almost as soon as the crisis was over. So we're looking here at the cyclically adjusted primary balance. So we're getting rid of interest payments on the debt, and we're getting rid of the cycle itself, right? So sometimes you will get the fiscal fixing itself because growth is a little higher and revenues are rising and costs of the social safety net are going down. We're stripping that out. So when you see the lines going north, that is essentially increasing taxes and cutting spending. And we saw that across the board in the developed world as soon as kind of mid-2010, and we saw it in droves in 2011 and 2012. And as a result, the global economy slowed down precipitously. The Eurozone suffered a double dip. It does not look like we're going to do that this time around. As we look forward to 2022, it doesn't seem like there's going to be much fiscal austerity. I don't think we'll see it in 2023. I think governments realize that they made a mistake 10, 11, 12 years ago, and that this caused the economy to grow so much more slowly than it might have otherwise. And there is this notion that with interest rates so low, you can carry a higher debt burden. So I don't think we're going to do austerity. That, I think, will be different. What else might be different going forward and has been different is the way that these central banks have been much more aggressive. So we'll look at the Fed first. And the picture here is really more about what the Fed did early on during the pandemic. The money that the Fed got out the door was not to backstop really the banking sector and deleveraging by banks. It was to backstop Main Street, not Wall Street. So it backstopped mortgages, it backstopped corporations, and tried to ensure that money could flow to households and to non-financial corporates. Going forward, I think the Fed is going to continue to increase its balance sheet. We'll talk about tapering or what have you, but I think the Fed is ready to be there as a backstop. And we know that quantitative easing alone is not enough to generate inflation. It's more about the fiscal. And we'll see how this fiscal proceeds as well. But the combination of monetary and fiscal, both remaining very loose, is I think what could be quite a bit different as we think about this next business cycle. What about the idea of monetizing the debt? Again, I'm going to go back to history. We monetized about 20 or 30% of the cost of World War I and World War II just by printing money. And by doing that, we helped to generate inflation. If you look at the light blue line, that is US public debt outstanding as a percent of GDP, and it rises sharply during World War I, the United States being involved in 1917 and 1918, and then during World War II. And you can see that inflation also followed. Higher inflation when you monetize the debt, when you're printing money, when velocity is positive, when the output gap is positive, and when there's no deleveraging in the economy. If you fast forward to the global financial crisis and its aftermath, it looks like we kind of monetized a good chunk of that debt as well. But the blue line would tell you we didn't, the dark blue line would tell you we didn't get much consumer inflation. Again, why not? For the very same reasons I've mentioned before. You can monetize some debt, but if you have a negative output gap, if you have deleveraging, if velocity of money is declining, you're not going to generate inflation. So I'm leaving you with the idea that you do need an awful lot of things to happen persistently in order to generate persistent consumer price inflation. What else might be different this time around? Inflationary expectations are a fascinating element of all of this because we really don't understand how inflationary expectations are formed, and we don't know what would really cause them to be unanchored. The Fed always talks about trying to maintain the anchor of inflation and expectations. The ECB, the European Central Bank, they have lost their inflationary anchor. People think inflation is going to be low and well below their target forever. The Bank of Japan lost its inflationary expectations anchor decades ago. People in Japan think inflation is going to be 1% or lower forever. The US, that's not the case. And most recently, expectations around inflation, as we see through market measures like a 5-year break-even inflation, the difference between real yields and nominal yields, that has been rising and is at a 15-year high. It's almost at an all-time high, dating back to the beginning of when TIPS were initiated. So that tells you a little bit that inflationary expectations are higher. Will they maintain this level? Will they go higher? And will actual realized inflation drag people's expectations higher? And if it does, will that matter? Thinking about history again, there still are probably some roadblocks, even if inflationary expectations go higher. And one of those roadblocks has to do with wages. So what about the Phillips curve? Traditionally, the Phillips curve, or going back to its origins, the Phillips curve was looking at the relationship between unemployment and wage inflation. We've sort of conflated that today by thinking about unemployment and consumer price inflation, skipping right over the step of wage inflation. But if you look at the chart here, you can see that when the unemployment rate falls, inflation rises for the first half of this time frame, pretty much like clockwork. Unemployment falls, wages rise, and that seeps into consumer price inflation. If you fast forward to the last few business cycles, you can still see it, but it's far less palpable. And you can barely see it in the global financial crisis and that business cycle. The unemployment rate falls to generational lows of about 3.5%, and we get very little inflation, even though we got some wage inflation. So I think you need to see this wage Phillips curve return, but that won't be enough. And again, one of the reasons could be that either companies wind up eating wage inflation and it hurts their margins, or we wind up seeing higher productivity, and that allows companies to pay labor to maintain their profit share, and then you won't necessarily see inflation. But this could be part of the story, both inflationary expectations and wage inflation. Moving aside from some of these other issues and looking at something that is kind of off the beaten track a bit, it looks like we're going to rethink how we produce things around the world now, and that could be viewed as sort of the reversal of globalization. We think that globalization was disinflationary. If we reverse this to some degree, perhaps that will be inflationary, or at least it will no longer be disinflationary. So as a result of tariffs and pandemics and people focusing an awful lot more on the environment and shipping things around the world in a very dirty way, instead of producing things where they are far flung around the world in terms of securing your inputs at the lowest cost of production, we may wind up bringing things a lot closer to home. We may shorten those supply chains. We may have supply chain redundancies. In a world of just-in-time inventories, we may need more inventories. That could be inflationary. And all of these things that could come into play, thinking about security versus efficiency, having the state involved more. This rhymes to me with a little bit less globalization, or perhaps globalization going in reverse. And at least for the next couple of business cycles, perhaps instead of this being a tailwind for disinflation, it becomes a tailwind for actual inflation. And finally, I never really liked this reasoning, but we often use it anyway. There is no alternative. How do you get rid of this unsustainable debt path that we are on in terms of public sector debt? We have higher public sector debt now than we've had for the entirety of American history, and many countries are in the same boat. How do you get out of an unsustainable debt profile? Well, you can default, but we don't do that in the developed world. You can try to grow your way out, and we've been trying. You can repress your way out by keeping interest rates lower than they otherwise would be. We've been doing that as well. You could austerity your way out by raising taxes or cutting spending. We tried that last time around. It didn't work. We could depreciate our currency and try and export our way out. But that's probably a zero-sum game, and that everyone will try it, and then you could get currency wars. The easiest way to do it is to try and inflate your way out. We've been trying, but will this time be a little easier, given that we seem to be making this political decision to persistently move forward with quantitative easing and more fiscal loosening? As another sidebar, just to keep in mind, much of what I'm talking about here, I think, is more specific to the US than it is to Europe or Japan, or a bunch of other developed markets. And it probably doesn't really apply that much to emerging markets per se. I have to note here that the Fed's new framework is really quite important. The Fed is now structurally the most dovish central bank in the world. They have changed their framework in two ways. One, they are saying that they want to overshoot their inflation target for some time by some amount, and they're leaving that purposely ambiguous. No other central bank is really saying that to that degree. And they're also telling us that they would like to see the labor market heal, not just along a few metrics like the number of payrolls or the unemployment rate. They want it to heal in a much more equitable fashion. They want it to heal for different ethnic groups. They want it to heal by gender. They want it to heal by education level. And they're being much more explicit about this than they ever have. So I think the Fed is going to be easier for longer, and that could generate some more inflation, at least early on in this business cycle. I've already talked about modern monetary theory. The US is more likely to do that. The US has been more, let's use the word generous, with its fiscal stimulus than any country in the world. The combination of that Fed framework and modern monetary theory in practice would probably result in the US being more likely to generate inflation than others. Inflation is already entrenched lower outside of the US in the developed world, especially in Europe and in Japan. Potential growth rates are somewhat different. And then we'll see how currencies come into play. I think it'll be easier for the dollar to depreciate and perhaps allow us to import a bit more inflation than it would be for other central banks and other currencies. So where does that leave us? We look at those disinflationary forces, these secular forces, demography, high levels of debt, digitalization, winner take all, rise of intangibles. These are powerful dynamics. Will they have met their match now in the combination of quantitative easing along with modern monetary theory and debt monetization? Will we wind up seeing velocity of money, that sloshing around of money, rise instead of fall? Will the money get out the door in terms of broader measures of money with no deleveraging in money multipliers? Will people's expectations of inflation rise? The de-globalization, and we're running out of options. I think this time is different. These inflationary forces on the right are going to provide more of a headwind for the forces on the left than we have seen in at least a couple of business cycles. I don't want to leave you with the idea that I think we're going to see anything that comes close to hyperinflation. I don't even think we're going to see inflation that's above, let's say, 4% for any great length of time. But inflation in the last two business cycles was 2-ish% at most. And I think that the prospects for inflation to be higher than that by some meaningful amount, 2.5, 2.75, maybe even pressing on 3% as an average for this next business cycle is greater than it has been in quite some time. So in terms of asset allocation, well, some of this stuff I think we've already front run. If you're worried about inflation, you would buy inflation protected securities. TIPS have done quite well in the last 7-8 months relative to nominal bonds. I think they're stretched here, so I'm not sure there's that much more to go. If real yields are what are going to rise going forward, TIPS won't help you there. Limited maturity, so if you have short maturity bonds, that won't be impacted as much by inflation. Floating rate securities that float up with inflation and helped you to protect your asset value. Value equities have been doing much better in the last 6 to 12 months relative to growth equities, where growth equities just crushed it in the last business cycle. And then things that are like hard assets, commodities, housing. And the last two bullets are, it depends. If we see higher inflation in the US for the wrong reasons, not because of growth, but because of costs, that's probably negative for the dollar if it's happening that way in the US, but not in the rest of the world. And EM as well, I think, depends. If the rest of the world is growing and there's a little bit more inflation, that's great for EM. If the rest of the world isn't growing quite as quickly as the US and it stalls and the US gets a little more inflation and that causes interest rates to rise, that's not good for EM at all. So you would short the dollar if the inflation in the US is greater than it is elsewhere, and you would go long EM if the growth in the rest of the world picks up and that the inflation isn't the main story, it's a growth story more than an inflation story. So that is my broad story. I'm sticking with it. We'll see how this all plays out. And back to you, Ted, so we can field some questions.
All right. Thank you, Eric. That was really informative and a nice refresher in Econ 101 for all of us who haven't dusted the book off in a long time. I'll start with a pretty basic question here. There are myriad indicators for inflation, more coincidental than causal. But which factors or indicators do you consider the most important or most helpful in indicating this future long-term inflation rate?
So I'm looking at this notion of persistence, right? So if you look at money growth and credit growth, it vaulted higher in the middle of last year, and it's already rolling over quite seriously. Year-on-year levels still look like they're going up, but 6-month annualized, 3-month annualized. If you print an awful lot of money and it gets out of the system, gets out into the system once for 6 months, that doesn't do it. So I'm definitely looking at measures of credit growth, which you don't see every day. I'm talking with our bank analysts and seeing how easy it is for them to get credit out the door. The fascinating thing is you think about the macro that I've just presented and the micro. Banks really want to get money out the door. They're itching to provide credit. The demand just isn't there. So if we start to see the demand pick up for credit, then that I think will give you a pretty good signal that perhaps you can see some persistent inflation a little bit longer than what the Fed is thinking. Another thing just to look at, and it's not anything magical, but stop looking at year-on-year numbers because they are totally muddied and cloudy by what happened a year ago. You really want to look at the month-on-month, and then you want to dig in. So when we saw inflation month-on-month numbers for CPI that were really high for the month of April, what was driving that? And I guess there's a little pun there because much of what was driving it was used cars. That's not likely to be persistent. Another driving factor was things that rhyme with reopening, like airfares and hotels. That won't be persistent. Where it becomes more persistent in things is in things that rhyme with housing, like owner's equivalent rent and medical care. And that doesn't look quite as problematic at the moment. So I would argue that you really do need to kind of pick apart the basket of inflation to get a sense for this, and then also look at the credit that's likely to be in the pipeline.
Okay. Follow on, you've mentioned a couple of times through the talk, but let's maybe see if we can nail you down exactly. What is your estimate for the long-term baseline inflation rate beyond this short-term COVID pop, however you define it? And then follow on to that is at what level would it cause the market to panic and really cause market disruption?
So those two questions are really quite different, I think. I'm looking for inflation over this next business cycle to average over 2%, and I think it's going to be closer to 2.5%. And it wouldn't shock me if it approaches 3%, but I don't think we're going to get there. I don't think we're going to have an answer really on the persistence of this bout of inflation that we're witnessing right now for a while. I do think that it's not going to be, 4% inflation for any great length of time. I think there are too many things that are going to be short term. These global bottlenecks, the capacity with computer chips, the shortage in automobiles and used cars. But it becomes a little bit semantics because if you are experiencing inflation for 12 months, 18 months, 24 months, it's going to feel persistent to you, and it's going to feel persistent to market makers. And they will run, I think, with a narrative of, oh my gosh, this is a different environment, and I'm losing money in my bonds. I'm losing money in at least some pockets of equities. PE values are too high. Ultimately, I think we're going to settle down into something that's not particularly problematic. Inflation of 2.5 to 2 3/4 is not something that's going to crush your bonds. It's not something that's going to crush PE values, but we may go through a panic before that happens. I'd also say, interest rates here, 10-year yields at 155 as of this morning just strike me as just so low relative to the amount of nominal GDP that we're likely to see. But I think everybody feels that way. And we've gone from a high of about 177 in 10-year yields to now 155. And I think people are starting to get a little frustrated. I know I am. I am short duration. I think bond yields are supposed to go higher. They're going lower. So, I'm going to stick with the idea that they're supposed to live in a higher envelope. Some of that because we're going to see higher growth that I do think will be a bit persistent, and some of that because of higher inflation, which I think will feel persistent. But that's not the way the market feels right now. The market wants to take us lower.
Thank you. Let's look at some other questions here. Someone asks, Alberto Cavallo has stated in his Billion Prices project, he's detected a drop of at least 20% in aggregate supply. If this is true, doesn't the basic macro supply and demand curve analysis predict much higher inflation than your slide would suggest?
So again, I think the Fed would say yes, but it's going to be temporary. So if the supply has declined because of bottlenecks, if the supply has declined because we haven't fully reopened the economy, if the supply has declined because labor is sitting on the sidelines until people are vaccinated, until kids are going back to school in person, until the generous unemployment insurance benefits roll off, all of that should look a lot better by the time we get to the fall. And I think this is what the Fed is banking on. The Fed is going to sit on its hands and say, we think this is temporary, and we're going to prove it to you by the time we get to the end of the year. The market may have other thoughts on its mind saying, hey, Chairman Powell, you got this all wrong, and, start pricing in higher interest rates. But at the moment, it looks like the market wants to validate what Chairman Powell is pouring in the punch bowl, and that is that inflation isn't going to be a problem longer term. I'd also note, if you look at the term structure of break-even inflation, or you look at the forward curve of break-even inflation, the break-even levels are higher in the short term than they are in the medium term. So break-even inflation for 1 year is higher than for 2 years, is higher than for 3 years, et cetera. And that would suggest that the market agrees that the inflation that we are seeing now and are likely to see in the next bunch of months is going to be short term, and that it will settle back down to something considerably lower. I would argue, even as it does that, it's going to settle down, but not quite as low as during the last business cycle.
Another question here. Is there any way to include financial asset inflation into this picture? Bonds, stocks, houses?
Well, there certainly is, right? I mean, I will go back to
That's another hour-long talk.
It is at least that. Here's what people say, and they're being disingenuous. I said in 2008 and 2009, quantitative easing, it's going to generate inflation. So if I wanted to right now, I could say I was right. It generated asset price inflation. Aha. Well, of course, I didn't think that. I thought it was going to generate consumer inflation. It has generated a tremendous amount of asset price inflation. If that money doesn't find its way into the real economy, it's going to find its way somewhere. And as corporations and households are sitting on the money and not spending it on consumer goods, not spending it on inputs to producer goods, then it winds up going into assets, and it has inflated assets. One question that I think we're supposed to ask ourselves is that asset price inflation persistent? And I think it probably isn't. It gets to the idea, again, going back to early macro textbooks and thinking, can you generate real output, real wealth with nominal variables? The nominal variable here is we're printing a tremendous amount of money. Can the wealth be persistent from that real wealth? We have net worth right now as a percent of GDP at an all-time high. But is it real? And it strikes me that it shouldn't be. It may wind up being in practice, but given all the money that the Fed is printing, I think you should feel like it's a little ethereal. It doesn't feel real to me. It feels more nominal.
How does it unwind?
Unpleasantly.
That's what I
Um,
would have said.
you
So,
know, I mean, um, I think we are again inflating bubbles, and we will pay the price for them. And I think there's some hubris here by public policymakers that you can just continue to move forward with ultra low interest rates and print money and spend money and take on debt, and that there won't be some equilibrating factor somewhere, and there will be, at some point.
question here, and that are we at peak stimulus right now? No more $1,400 checks in the future. Infrastructure and family support plans are spread out over 8 years or so instead of hitting all at once. So is inflation likely to start receding in a year or so, which I think you've probably already alluded to?
I think that that's right. I think we have seen the peak impulse in fiscal stimulus. We will get some sort of infrastructure project, but that's a much slower bleed than the stimulus that we have seen several times over the last, whatever, 18 months at this point. So the budget deficit for 2021 is likely to actually be higher than 2020 unless growth is yet even higher than we think. And then the budget deficit will decline as we go to 2023, 24, 25, not necessarily because of fiscal austerity, but because revenue is rising and the social safety net costs are falling. But I think that impulse will wane. If the labor market can pick up the baton from the fiscal, um, it doesn't necessarily mean that growth has to fall back down to kind of the 2% economy, which is what we saw in the aftermath of the global financial crisis. It could be a bit more robust. A lot of that, I think, is going to depend on what happens with productivity.
Okay. Another question here, which is maybe more statement than question. It said, isn't the increase in money supply essentially dry tinder for inflation that could be set alight by an increase in bank lending that is not within the government's control so
So
much?
that rhymes with the idea of the velocity. You've got all this money on the household balance sheet. You've got all this money on the corporate balance sheet. If the household, if households and corporations and financial corporations decided to deploy this all at once, you would have a burst, I think, of inflation. And then you would get persistent inflation if the Fed decided to make a policy mistake and say, no, we're not going to raise rates. We're going to let it run. So that's where it kind of becomes a political decision.
There's a good definitional question here that I think many thought about but were afraid to ask. Could you please define exactly what you mean by debt monetization? What does that mean in practice, bank lending and consumer spending, et cetera?
The short answer is who knows. I think the longer term answer is you know it after the fact, right? So if the Fed increases the size of its balance sheet as a percent of GDP, and I think that's the right way to view it, not in absolute terms, but as a percent of GDP, and it doesn't then allow for the balance sheet to roll off. It doesn't allow for the balance sheet as a percent of GDP to come down ever. Then I think definitionally that's monetizing the debt. So if you look at this last cycle, the Fed allowed some of the balance sheet to roll off. Debt as the balance sheet as a percent of GDP did come off by several percentage points. And I think the Fed would say we didn't monetize the debt. We were always going to rationalize the balance sheet down to some level, not all the way back down to 7, 8, 9% of GDP, which is what the balance sheet looked like in 2006, but something considerably lower. If 20 years from now, we look and we see that the Fed's balance sheet as a percent of GDP is 10%, then we will be able to say that they did not permanently monetize the debt. But you won't know that until well after the fact. I think, for us who are living through it, it certainly feels like you're monetizing the debt. The Fed would, I think, retort, give us time and let's see if we can roll that balance sheet off. I think that's not a very satisfactory answer, but I think that's the one we're left with.
Mm-hmm. Okay. Sort of political question. How can you forecast what the Biden administration can pass when the country's so divided politically? If the Republicans take the House and Senate in the midterm election, wouldn't that change what Biden can do? I guess the question is there enough in the pipeline underway already that the train's leaving the station?
So I think what's potentially really ironic is modern monetary theory would, I think, suggest that as long as interest rates are low and the output gap is negative, that is, you have high unemployment and capacity utilization is relatively low, and you print your own money, then you should be able to finance whatever size deficit you want. As soon as interest rates start to rise, which should happen along with the output gap uh, going from negative to positive, the fiscal policymakers should stop and say, enough. We need to raise taxes a little bit and we need to cut spending. How you get 535 policymakers to do that, I think, is anyone's guess, and why it's a little bit easier to think of the Fed and its 17 members or 19 members to do that when all the seats are filled than it is for the fiscal policymakers. The irony, again, would be that the House or the Senate flips, and all of a sudden, fiscal policymakers basically turn the spigot off because Republicans are not going to want that much more fiscal spending. And then you'll have those who are proponents of modern monetary theory say, aha, I told you it would work. All you have to do is make sure that fiscal policymakers are responsible. Well, I think we all know fiscal policymakers aren't responsible. If the Biden administration is able to maintain control of Congress into 2023 and 24, it could be a very different story. And perhaps they will try and get more fiscal out the door, which is not what you're supposed to do if you believe in the tenets of modern monetary theory.
So to follow up to that, I guess the question is sort of built-in multipliers. The 70s inflation period, a lot of that was on the backs of the COLAs, the wage increases that were tied to inflation that just created this opposite of a virtuous circle. There's talk of indexing the minimum wage to inflation and other labor, very much pro-labor sort of policies. That would be one way for the Biden administration to persist in its influence. Do you see any of that creeping in that prevents the Fed from really, stopping or Congress from stopping when it's time to stop?
So if we go back and think about the 60s and the 70s, that's exactly right. An awful lot of economic activity was indexed to inflation, which is how you can get this vicious cycle, right? So you see there's a negative supply shock globally in terms of food, in terms of energy. Prices go higher, wages go higher, labor unions are powerful, and then everybody's passing prices along. If the Biden administration were successful in indexing the minimum wage to inflation, at the margin, that would matter. But when you think about the wage pie, the wage bill in its entirety, so all of the hours worked and what they are being paid, those hours worked that are affected by the minimum wage, and let's say just above the minimum wage, because those hours are affected as well, is still a relatively small piece of the overall wage bill. Somebody who's making $100 an hour, the change in their wage inflation is a lot more important than someone who's making $20 an hour. So if we increase the minimum wage and then we index it to inflation such that that's going to go up 2 or 3% a year, that will matter. But for the entire wage pie in its entirety, it's probably pretty marginal. Where it would become, I think, much more meaningful is if you tie all sorts of other contracts to wage inflation. If you can see labor unions become more powerful and they are demanding that their wages not only keep up with with consumer inflation, but then an extra percent or two. That's a very, very different story. And then you're kind of painting a picture where inflation would become more entrenched, inflationary expectations would be entrenched higher, and you would probably live in an envelope of considerably higher inflation.
But at a minimum, or well, minimum wage is not a big enough tail to wag the dog. It is how much else seeps into what the Labor Department's doing, the support it's giving for unions, et cetera.
Yes.
So we are pretty much over time here. I want to respect everyone's time. It's a little after 1, and I want to thank Erik. Thank you so much for coming today and presenting this really interesting presentation. Hopefully folks got something out of it and we answered all your questions, or as many as we could. With that, I will sign off. And again, we thank everyone for coming, and we thank Erik for presenting.
Thank you very much.
Okay, very good.